Thank you for the introduction. We have a couple minutes before 11, but I've got quite a few slides and quite a few things I'd like to talk about, so I'll go ahead and start off the presentation now. So I am the president of goldandsilverseek.com. I've been a precious metals investor since a teenager for almost 25 years. And I'd like to talk about some of my precious metals picks at the end of this workshop, but I'd like to start off talking about debt, money, and then its relationship to gold. To start off, I'd like to start off with kind of a old but famous quote, and it goes, "Gold is the money of kings, silver is the money of gentlemen, barter is the money of peasants, but debt is the money of slaves." So let's go ahead and start talking about debt. I started GoldSeek in 1995, and at that time, we were already looking at the debt problem as a growing problematic situation. In 1990, so I went back to 1995 to look at where things were at back then as a reference point. Gold was $400, silver was $5 an ounce. The U.S. deficit was $5 trillion. Today it's $22 trillion and growing aggressively, and the debt to GDP ratio was just over 60%. Today the situation is a lot different. So let's start off with looking at the debt situation on a global perspective. As of Q3 last year, it was reported that global debt has now reached $247 trillion. That is an absolute astounding amount. What is $247 trillion? Well, first, it's been growing at a rate about $15 trillion per year on average for the last 10 years. This is an unsustainable trajectory, and it's absolutely gobbling up the whole global economy and saturating in debt. If you look at it in a gold perspective, it's more than 35 times the value of all the gold ever mined. All the gold in temples in India, all the gold in jewelry, bars in central banks, so on. On a relationship to GDP level, that's over 300% GDP to debt levels. These are absolutely unsustainable levels. This is a Bloomberg chart showing you the growth of the global debt. This was before the latest update was at 237 trillion. You can really see the explosion in debt over the last 10 plus years. Back in the mid-90s, global debt was something like 67 trillion and it's just exploding. One of the biggest explosions in debt has been on the national level. Global governments have been printing money, running deficits at an incredible rate. It's not just the United States, it's not just China, it's global. On a global basis, national deficits have now hit $73 trillion. And it's not just, as I said, in the US or Greece or other problems. This is a global map of GDP to debt levels. And the red levels show debt levels around 100% or more of GDP. So you can see it, Greece, and I have a chart of that coming up, that was a big latest problem with debt. But the US isn't too far behind. Canada isn't too far behind. You look at Italy, France, Portugal, it's horrible. And here's looking more at the EU perspective. So you can see Greece there around 180% GDP to debt levels. Italy's starting to have big problems. You've seen a huge shift in their government politics there and the infighting within the EU. So, if you look at the EU on the whole, it does not look good at all, except for maybe a few economies in there. You got to commend Germany for its reduction of debt, but most of the other economies, they're just continuing to add more and more debt relationship to their GDP. The United States, it exploded after the last financial crisis. Nothing has been resolved. Nothing has been fixed. The debt continues to get worse. We're over 100% GDP to debt level, and that's with a very strong economy, and that's with all the different bubbles out there. Now, the mother of all debt to GDP ratios is Japan. This is the second highest level ever in history recorded. We're looking at over 250% debt to GDP level. They have tried almost everything possible over the last decades to pull themselves out of this, including issuing more debt to grow themselves out of the debt. So their strategy has been to cheapen, they've been in negative rates, they've been printing trillions and trillions of yen, they've been buying up their stocks. Today, the Bank of Japan is the largest shareholder in majority of the largest Japanese corporations. In many cases, they own 70-80%. They've pretty much nationalized the companies. They cannot get out of this debt trap. And there's only an obvious solution to this, and that's default. And that's default through either deflationary crash or printing their way out of this through inflation. And they just wish they could pick up some inflation. It's not happening. Japan is just in this debt trap. And what happens is you have lost decades of growth. They've been able to survive in this situation for such a long time because the rest of the world economy has been chugging along. So This is all caused by central banks. Central banks are the creators of these massive levels of debt. In today's world, most of the currencies aren't backed by gold. There's nothing restricting its creation of new currency units. So central banks today have found a way to become modern-day alchemists. Where in the past, kings have tried to create gold out of hay or other metals or chemicals, well, central banks today have figured out all they need to do is hit the keyboard and they create new money. But there are consequences for these actions. Central banks have distorted the free market in a tremendous way. We no longer know what the true free market price of anything really is. Asset prices are distorted. Capital has been going after one bubble, whether it's a real estate bubble, the stock market, equities. I mean, money is, all this easy money is just floating around and it's showing itself in different ways. And this is going to be a very severe consequence when there's a reset in these markets. But that's made investors, it's turned us into speculators. Investors are no longer traditional fundamental value investors. We are speculators. Everything is in a bubble today except for commodities, precious metals. So when you're investing in the stock market, you're not an investor, you're a speculator. And remember that speculators can make quick money, but they can also lose money very quickly. It wouldn't be appropriate to look at debt without looking at global wealth. And global wealth has exploded, tremendous explosion in global wealth over the last decade. So even though we went through a financial crisis, there was a loss of wealth in real estate and stock market valuations for a while. It's all come right back. $317 trillion in global wealth was the number late last year. I would say this is probably coming down to around 300 trillion after the stock market corrections and real estate markets are starting to slowly correct. But how did this get so big? And again, it comes back to the central banks. Here is an important chart because this is really giving us an indication of what's happening right now and where we're heading into in the coming years. This is a cumulative representation of central banks and their money printing monetary QE policies. The red line indicates the net total, Bank of Japan to US, the Europeans, the Bank of Canada. What are they doing? And we're now entering in a period where they're going more into neutral, if not into a slight negative territory. We know in the United States, rates have been increasing. We have seen their balance sheet unwinding slowly, and other central banks are starting to raise rates, and we're seeing a tightening of liquidity in the markets. And this is not a good news because liquidity, their easy monetary policies have led to all these bubbles. So what happens in the reverse? Well, we're going to see some spectacular resets in various markets. That said, there's no question that the second things start to get difficult again, the central banks will come right back in and start printing money. And we saw that last week. Last week, it was the Chinese central bank introduced over 1 trillion won into the markets, into the banks, adding liquidity. China is going through some very serious financial, economic problems. There's some out there who believe that they're heading into a big financial crash. A crisis is developing. Bank of Japan, Europe Central Bank, U.S. Central Bank, the last week they also started expanding their balance sheets again, and the stock markets have started to recover. So you can see they're starting to push money back into the markets. So they're there to support these bubbles, but at some point it's unsustainable. So as mentioned, everything's in a bubble except for commodities, precious metals. And this has been fueled by these really cheap, low interest rates and easy monetary policies. This is the interest rates of the United States. There's been no reason to save capital. There's been every reason, every incentive to speculate, to throw money into the stock market. You put your money in the bank, you get 0% return. Why would you lend money to the bank with risks when they give you no return? So everyone has been pushing money into different markets, into different bubbles. Here's a representation of the net worth of the United States versus GDP level. You can see that also shows that there's a big divergence between actual economic growth and the valuations of wealth. The valuations everywhere are just absolutely reaching record extremes. This is U.S. household net worth versus GDP. Again, it's at extremes in bubble territory. Well, one of the biggest bubbles of them all is the bond market, and the other one would be the stock market. Now, the stock market has had an interesting, all of a sudden, volatility hit the market. There was a huge correction in the U.S. stock market. Suddenly, we've had just a steady rise in the U.S. equities, and globally, the stock market suddenly started to sell off. Well, I would take that as a warning signal. It's an indication that tightening of liquidity in the system is happening. Central banks are raising rates. People are being more conservative. Liquidity is a question. You see liquidity in, say, the ES futures for the S&P have really gotten tight in the last year. So there's something going on. We may not know exactly what's happening at this point, but we will start to know more about in the coming months or year as things start to come out in the news, whether it's bank failures or sovereign debt issues developing, especially in emerging markets where they are most vulnerable at this time. But this is an indicator. The stock market falling that quickly. There's a lot of things happening in politics, trade wars, and so on. But you look at valuations in the stock market, we're at around 30 PE ratios. These are historically high levels. Where do you go next? Where do people put their money next? Housing, that's a huge bubble. U.S., you see it, this is in the U.S. perspective. Up here in Canada, the bubble is significantly worse. I would be very worried to be a Canadian real estate investor. I would rather be looking to buy here in Canada over the coming years when there will be some significant deals as we globally go into the next global recession. But in the end, the biggest bubble of them all is in the monetary system. The debt and everything is reflected back in money. We really didn't have a monetary problem back in the last financial crisis. Central banks stepped in. There was ways to stimulate things and keep things going. But as we know, nothing was resolved in the last 10 years. Global debt has exploded. Rates were cut to lower rates. There's been just bigger distortions. So when we go through the next debt crisis, which is developing right now, it may take years, 2, 3, 4, 5 years for it to really develop in a very serious manner, but we'll see the representation of that show in the bond markets and ultimately in the value of currencies. So money today is not backed by anything, really. I mean, you have some gold in central banks, but directly linked to money, there is no link anymore. Money today is a representation of debt. It's a continual debasement of value and destruction of value. Money today is a promise to pay. And that's a very big thing because money is based really on trust today, the trust that there is value. And globally, when there becomes more economic problems, and now as we're entering a period where we have trade wars and battles between various countries, trust can really break down. And that's when we really see things really crack and move fast. So I think the combination of geopolitics, economics, and debt is starting to play out, and money is going to represent, the value of money is going to really represent this in the coming years. Money does not survive. It does not retain its value over the long term. There's been thousands of currencies. The average lifespan has been around 27 years, and ultimately they return to their intrinsic value. And since they're based on no backing of gold, that is zero. And it's not just the dollar. I think the riskier currencies right now are going to be the yen, the yuan, the euro, ruble, lira. These currencies all are experiencing massive debt levels, and we're seeing competition and breakdown of trust between these nations. Now, the dollar remains the king currency in the world. It is the gold standard still, but there has been a move to get away from the U.S. dollar globally. In the last 2, 3, 4 years, we've seen the two-third global reserve status where the U.S. dollar represents around 65 to 70% of the global reserves in central banks. That has been falling. We're starting to approach a low 60% rate as different economies are starting to trade, whether it's China and Russia, India and China, Japan and China. They're starting to trade less and less with U.S. dollars and more using their other currencies, whether it's the yuan or others. And I believe what we'll see is that gold becomes more prominent as the currencies themselves have problems. So you see Asia itself has been growing, but China's economy has been growing. It's a monster. It's trying to compete with the U.S. dollar in many different ways. And for China to compete globally, they need to really build trust and integrity in their currency. And one of the ways they're doing that is buying a lot of gold. And that doesn't go just with China, Russia. A lot of different places are buying gold to support their currencies. But in the end, they're issuing more and more trillions and trillions of debt faster than they are representing their treasuries with gold. Just a real quick look in the U.S. side, because the U.S. is really the key here. When things start to happen and things get serious, whether it's in Europe or other places, people will flood to the U.S. dollar as a safe haven. And that has been kind of the case for a while now. But eventually this is going to fall apart. And after the U.S. dollar starts to lose its value, I think that's when the gold price is really going to explode, because there's nowhere to hide after that. I don't think the euro is a good place to be. The EU has tremendous amount of problems. We've been living in Europe for the last 4 years, and you just see the tearing apart of different politics from east to west. You see the issues within the different countries of debt levels, different cultures. It's a big problem, and you see Britain trying to leave the European Union. You have in Paris right now, the Yellow Vest movement that's not very reported in the media. There's a lot of resentment to what's going on, and people have said they've had enough. They're sick of globalization. They're sick of seeing their jobs leaving, and it's a representation of preserving their economies, this populism, and it's been represented in Trump in the U.S., and it's starting to spread globally. But in the U.S. side, it's not all that great. Trump has had some positive effects in some ways by bringing optimism to business leaders, cutting taxes, but at the same time, he's been growing the deficits at an incredible rate. This has been an ongoing problem, but now we're looking at U.S. deficit exploding at an annual basis of over $1 trillion a year. $1 trillion is 800 million ounces of gold. And it's just not the amount of debt being issued every year, it's the cost of financing. They have dropped rates to historically low levels, trying to finance debt near 0% interest rates. So as the debt went from 5 trillion, 10 trillion a decade ago, now we're 22 trillion, it's growing. The yearly cost of financing this is starting to show up. And Deutsche Bank said that for 2019 in the United States, the cost of financing the deficit is going to be $650 or so billion a year as the rates rise. Now, that's just, what does that mean? That's 1.2 million ounces of gold per day, 50 tons of gold per day in interest payments on the U.S. national deficit side. You look at it globally, it's just exploding. It shows you these debts can never be repaid. So the obvious conclusion to this is inflation, inflating the debt value away, debasement of the currency, and eventually this will lead to hyperinflation. Now, that's destruction of value for people who have their money saved in dollars, euros, Canadian dollars, whatever. You are at the biggest risk of having your wealth confiscated. So, I don't have enough time to go through some of these other issues, but I think now is a time, and if you haven't been taking action yet, now is the time to be taking action, because when things happen very quickly. As I said before, there's a lot of things happening with geopolitics and so on, and I think that's going to be instigating the big financial crisis and shifts happening ahead. So just like an earthquake, when it hits, there's big shifts happen instantaneously. You're either protected or you're going to be a victim of what's happening next. And that's going to be bank bailouts where your money is going to be bailing in the banks. They'll be confiscating your savings. The governments are not going to be as eager to be coming in because they just simply don't have the resources to bail people out. So the next crisis is really going to see a lot of people be wiped out in different ways. And when that comes, you have to be protected. So what is your plan? What are you going to do about that? Obviously, precious metals is one way to protect yourself. And I think other ways, including being diverse in a geographic sense, is very important because capital controls are coming. I have to kind of rush through the last 4 minutes here. So gold market is looking excellent. There's huge fundamental demand. You're seeing India, China, Russia buying tons of gold. You're seeing even Poland, Hungary now buying gold, central banks. You're seeing a pretty interesting situation in a lot of central banks now acquiring precious metals. Global ownership of gold is at a historic low where it's around 0.5% of global savings. So there's a lot of potential for money to come into the precious metals market. So protect yourself by diversifying. Don't just be in one currency, be in multiple currencies if you need liquidity, but protect yourself with precious metals and being in different places. This is a time to be getting out of the equity markets. Here's an excellent opportunity. If you're in the stock market and you've been sitting on a lot of gains and you saw this market just crash, well, you've had this pump in the markets the last week. Here's your opportunity to be selling. I think at this time, the market has changed from, instead of buying the dips, you sell the rallies. This is a long-term view, technical view of gold. It's been in a nice uptrend. The key support is around 1,200 or so, but the key resistance is around 1,300, 1,320. So the second we see that break out, we're going to see gold really move to this next two levels higher, which would probably be around 1,500 and then around 1,900 to 2,000. So here's my 2-year view on gold. 1,250 has been kind of a wake-up call to gold investors. 1,320 is really going to get gold bugs excited. And then when we break 2,000, you're going to see gold bugs revive like you haven't seen them for about 10 years. Silver is the same situation, long-term downtrend. It's not as exciting as gold at this point, but as gold takes off, you'll really see silver take off in a big way. Mining stocks are on sale. They've been on sale for a while. This is an excellent time to be a buyer in the market. When buying these companies, the most important thing is to look at the management, projects, share structure, finances. And with that, I'd like to give you a couple of my top picks. Here's another perspective, the gold stocks versus the gold price. We're at historical lows in the ratio-wise. And again, you can be buying ounces for dirt cheap right now. One of my favorite companies is Gold Resource Corporation. I've been an investor since their IPO at $1 a share before they ran up to $30 with their mine in Mexico. On the pullback here now in the last, especially in this last several months, this is an excellent opportunity to be building a position. They started investing into another gold project in Nevada. They'll be doubling their gold production. This company has under 58 million shares, no debt, issues a dividend. The insiders are owners, management owners. This is the kind of company I love. This is one of the few rare examples of preserving your share capital and giving investors leverage to the upside. Next company is Northern Vertex. This company has had a really difficult year, and then on top of that, a victim of tax loss selling. I went to their mine a year ago. This mine is taking longer to get going, like many mining projects do in the last commissioning phase of it. They just hit commercial production. They're going to be producing around 60,000 ounces a year, low production costs. They've restructured their debt. They're looking a lot better right now, and the company is on sale. I would also recommend you going to the companies and speaking with the mining executives. They're here at the show. This is an excellent opportunity to connect with them, so I placed the booth number up there in the corner. Golden Arrow is another company for looking in the silver side with a gold exposure. They just started with Silver Standard, or actually SRM Mining. They have a 25% interest in Argentina. They're producing several million ounces a year. SRM is leading the project. They're there collecting the dividends from this, and even more interesting is their exploration projects. So I would talk to them about their their projects in Chile that they're working on. Endeavor Silver, this is a company I followed since the early 2000s in Mexico. They've got a nice growth profile, more and more gold and silver, still about 60% versus 40%. Pretium Resources, I invested this since the IPO. I just started buying again last week on the pullback. You know, it's great to be an investor and have cash on the sidelines because it always seems like these companies have these pullbacks, and it's always good to be buying them on these. This is an interesting buyout potential target. There's been a lot of M&A activity in this sector. And if you want to find other companies I'm investing in, I launched a 24K gold fund. So last year, I put $100,000 into an open source gold fund. You can see exactly what I'm investing in. And I'd like to report for the last year, we came out with a 10% return versus GDX, which had about a minus 5% return. So we were able to outperform them. And I've been a big buyer in the last week since a lot of different projects. I also launched the Ultimate Silver Fund last week. So you can find what I'm investing in that as well. And as a disclosure, all these companies I mentioned I am an investor in, and some of them are sponsors on GoldSeek and SilverSeek.com. If you want to keep in touch, GoldSeek, SilverSeek.com are the websites, 24K Gold Fund, and you can follow me on Twitter. And again, if you want to see more of the juniors and exploration projects I'm interested in, go ahead and take a look at 24K Gold Fund and Ultimate Silver Fund. At this time, that's all the time I have. I'm a little bit over, so I need to hand it over now to EMX Royalty, which is another excellent company, an investor, and for a long time prospect generator, and a company I would love to be accumulating at these prices as well. So thank you for your time, and if you have any questions, I'll be available at the back of the room. Thank you.